Oh, let's clap it up, everybody. Welcome to our second webinar. This is replacing our typical annual conference that we usually have every year. Everybody's remote. This is very convenient. This is very great. We're trying to keep this consistent and do it pretty much every other month. So welcome, everybody. Hopefully everybody's having a great Friday. It's only going to be an hour session, and we still have some people dripping in a little bit. We're still going to wait for that. Should I start and introduce Michael right now, or should I give it a second?
It might just be like this format. I think we're 5 minutes over.
Okay.
I think you're okay.
Yeah.
Okay.
Yeah.
All right, then. So welcome everybody again. We're going to introduce Michael. He's going to speak for 5 minutes. He's actually with payroll. He works with same-day financing for payroll as well. So I'm going to go ahead and let him introduce himself and talk a little bit as far as like how he helps businesses.
Thank you all for coming. Thank you, Prince, for that wonderful introduction. It's great to be here.
Anytime.
Thank you, Romeo, for the opportunity. I look forward to growing together with you, and hopefully we can help service your clients. Just a quick background, Payro was launched in 2019. We are specifically geared towards small to mid-sized growing businesses, and we take the stress out of payroll. You guys know what the biggest pain point in running a business is, and that's payroll. And that's why you guys partner with Romeo to take care of your payroll. Now, what happens if you guys are struggling or you have challenges with cash flow? And it's not a bad thing, because every business deals with challenges in cash flow. It's part of the growing process, and even profitable businesses can have some times where they will need a little bit of extra help, which is why we created Payro. Let's take one example really quick. You have a bakery. It's a mom and pop shop. They have 5 employees, typical revenue, supports their payroll. Some fancy food blogger comes in and tastes your croissants or donuts or whatever you're serving, and they go on Instagram and they've got 1 million viewers, and all of a sudden your shop is swarmed with new customers. Your business consultant tells you you got to open up an e-commerce shop. You need to do things fast. Otherwise, if you don't keep with the momentum, you're going down. You're just going to stay the same mom and pop shop you were. So you need to hire 25 new employees to scale your business. And you want to keep your current revenue in the business in order to be able to grow without incurring extra long-term debt. By partnering up with Payro, we'll finance the payroll for you. You treat the financing portion of the payroll as an invoice. So now you have all your cash that's coming in due to growing customer base. You keep that, you keep it in the business, you spend it on SEO, you spend it on fulfillment, you spend it on, buying additional equipment. And at the same time, you can hire more workers to cover that extra labor with a loan from Payro. What are the terms? Very simple. 1 week to 4 weeks. It's a short-term loan. You treat it as an invoice the same way you treat when you buy a pallet of flour and you have net 30. So with a payroll loan, it's for 28 days. You can pay it back 1, 2, 3, 4 weeks. Interest rates are 1.5% per week, doesn't compound. So say your payroll was $10,000 and we got you underwritten for a payroll loan of $30,000, and you're going to draw down on that. That's your line of credit. So if you draw down upfront for $30,000 for 1 week, your grand total cost is going to be $450 in interest, and there's a $100 per transaction fee. So every time that you will utilize your line of credit, it's going to cost you $100 plus whatever the interest is going to cost you. Now, there's no cost to sign up and have a line of credit from Payro in your back pocket for when you need to access it. You can apply online, and I'm going to put the link to the PayMaster portal, which is going to redirect you to our website, which then you'd be able to go online and get pre-approved. What does the pre-approval process look like? We analyze 6 months of bank statements. We analyze the cash flow. We see what the ability to repay is. We compare that with what your current payroll schedule is. And if there's a need for an increase going down the line, reach out to us. We'll get that line of credit increased. That's not a problem. We're here to help businesses grow. We're not here to put them in the tanker, which is why when you get a loan from payroll, the only thing that's necessary in terms of guarantee is a personal guarantee from the business owner. We're not after your business. We're here to help you grow your business. Unlike getting a line of credit from a bank where it can take 1 to 6 months to either get approved or denied. A merchant cash advance loan, nobody wants to go there. What's another option if you guys want to say, oh, well, I'll just dip into my personal savings account to cover payroll only this one time and then I'll pay it back. We know what happens. It happens in personal life and it happens in business too. Once you take the money out of the savings account and you put it into the operating account, you might as well kiss it goodbye. That's why with a loan from payroll, you keep your business running exactly the way it was before. You don't need to incur any long-term debt, and you'll be able to make payroll on time every time. I'm going to put my email address in the comments as well. If anyone wants to reach out with any questions, excuse me for that caps lock, feel free to shoot me an email. What I did forget to mention, though, was that on our portal, we have partnered with Finch and Plaid. Plaid gives you the ability to upload your banking software. Like this, we have seamless connectivity, as well as Finch will connect the payroll software. So we'll pull the payroll data to verify what the loan amount is going to be every single time. Like this, it's simple, it's easy. It takes 3 minutes to get pre-approved. There will be an introductory call from one of our underwriters. We make sure the story makes sense. You're a growing business. You know, we do a little bit of analytics in the background behind the scenes, and the pre-approval usually gets issued within 48 hours. When you do request funding for your payroll loan, it's same-day funding provided that you meet the 1 p.m. Eastern Standard Time cutoff time, and we wire it directly to your account so you guys have no more stress. Thank you.
We love it, Mike. Thanks a lot, Mike. Keep us stress-free.
All right, I'm going to drop off. Got some other things to do right now. Thank you for the opportunity.
And again, Michael's information is inside the comments. So if you guys want to go ahead and reach out to him, feel free to go ahead and look at those comment sections and, you know, get that information. Now, before I get to the great main event, Gary, who needs a great introduction, there's one thing I must discuss. I don't know if everybody's heard of it yet, the Employee Retention Tax Credit, something that we've been assisting thousands of businesses as of late, successfully get up to $26,000 per employee. There's a lot of misconceptions. Two of the biggest misconceptions of people not qualifying for the Employee Retention Tax Credit is that if you receive PPP money, you don't qualify, or also if you did not have a loss in revenue, you don't qualify. That is not necessarily true. Let us, the professionals, go ahead and have a conversation with you. It costs you nothing. And we also created a commercial that we wanted your feedback on, and also for you guys to take a quick look at. And if you guys have any other questions, my email will be in the comment section as well. So you can reach out to me if you have any questions about the Employee Retention Tax Credit. I'm gonna go ahead and let Romeo roll that footage.
It may be a little choppy presenting it this way, and this is our first draft.
I've got all these people that I hired. I got all these people who are counting on me. And when the state shut down my restaurant, I didn't know. What was that?
Oh, that? Yeah, that's just the employee retention tax credit you're entitled to.
Employee retention?
Hey, by any chance, have your gross sales been down in 2020 or 2021?
Yeah. I'm entitled to all of this?
Mm-hmm. up to $26,000 per employee. All you got to do is answer this little questionnaire, and we'll take care of the rest.
Hey, I've done more paperwork at the dentist's office.
I bet you have. And here's the thing: if we can't find you any money, we won't charge you a thing.
Sounds great. Hey, where does all this money even come from anyway?
Say hi to Garrett. Gary,
Nice to meet you.
Gary, meet Gary. Thanks a lot for watching our 1 minute commercial. Now it's time to get to the main event. Gary with all the accolades. Hold on a second. Is someone talking in the background?
Yeah, it's okay. We're gonna mute. We just need a moment.
Oh, okay.
And we'll have the girls here next week. I was hoping to have them here sooner, but
I'll wait until you mute.
I'm sure I'm mute.
There you go.
You got it?
Yep.
Awesome. Awesome. I can't have any interruptions. I got to do this introduction great. All right. This is Gary we're introducing here. So Gary,
Indeed.
I've known Gary for about a year now. He doesn't need an introduction, but I'm going to give him to him. He has over 33 years of employment law and litigation experience in South Florida as well as Central Florida. He has litigated countless employment and other civil matters and both state and federal courts of Florida, and his practice includes representation in matters of breach of contract, discrimination, harassment, retaliation, whistleblowers, and non-compete agreements. Again, introducing Gary Isaac. Go ahead and take over the show.
Thank you. Good morning, everybody. I'm not sure how to get my face on there and Prince's off, but I'm hoping there's a way to do that.
I can see your face.
I'm waiting for somebody to come here and spit money at me. If that's not happening, I'm not giving the seminar. Anyway, again, thank everybody for being here. Thank you guys for having me. I'm going to talk today about the Fair Labor Standards Act. And what does that mean? Probably most of you know, but the Fair Labor Standards Act is the federal law that governs overtime and minimum wage. It's been around for about 70 some years. I believe FDR signed it into effect, which is why when we say, gee, we didn't know the rules, federal judges tend to roll their eyes. As most of you know, overtime is if an employee entitled to it works over 40 hours in a work week, and that work week can run Monday through Sunday, Wednesday through Tuesday, whatever the employer wants, 40 hours in a vacuum that work week. If it goes over 40, that employee typically is entitled to time and a half. Minimum wage at the federal level continues to be $7.25. We'll talk about later. In the state, with regard to state statutes, that's all over the place. And y'all, wherever you are, please know what the minimum wage in your town, state, county is, because there are some municipal laws out there where if you're in this town, it's $15 an hour. If you're across the line, it's $7.25. I have left my window open so y'all can see the intercoastal and the ocean for those of you up north. Why is that important? Because I am happy to live in the Sun and Fun Fair Labor Standards Act capital of the world. The Southern District of Florida is #1 in Fair Labor Standards Act lawsuits. The Middle District of Florida, the Middle District of Manhattan, the Southern District of Manhattan tend to vie for 2, 3, and 4. It's growing across the country. So those of you up north or out west, when you get sued for this, you can thank some of my buddies down here in Dade, Broward, and Palm Beach County. You're more likely to get sued as a business, small, medium, large. You're more likely to get sued for overtime or minimum wage than any other employment claim combined. Why? because you probably should. It's fairly easily not to discriminate against somebody, to pay somebody their paycheck at the end of the week, to address someone who's disabled, to know someone needs surgery, needs some time off. Most of us at least can smell a problem and know enough to call a human resource professional or employment attorney or to look it up. The Fair Labor Standards Act is the most litigated statute out there because there's traps for those most well-intentioned employers out there. And that's what we're going to try to talk about today. We're going to try to talk about, the typical problems that someone doesn't see, the potholes along the way, that it unintentionally trip you up. I'll give you an example. I'm already going to apologize for, I know I'm going to mess up the document presentation today. I'm apologizing in advance. My paralegal wants to kill me right now because I was supposed to be any good litigator who has a 1 o'clock seminar or 1 o'clock deadline doesn't really get going till 12:15. My paralegal's not happy with me this morning, but the reason is, and it ties into this, is I have a client who just got hit with 2 class action suits under the Fair Labor Standards Act for deducting for 11-month period $2 breakage fee from their restaurant bar. So every 2 weeks they took $2 out of these highly compensated servers. That $2 voided the tip credit portion of the Minimum Wage Act. So because of those $2, we're looking at a $350,000 problem. So the fact that they wanted to talk to me this morning may tie into, if I'm choppy here today, you can blame that $2 coming out. What you want to avoid here is anyone walking into a plaintiff's employment law attorney's office, because once they walk in, we're in trouble. And like the guy who realized $2 wasn't supposed to come out of those paychecks. And when you walk in and there's any kind of issue, the answer you're going to get from me or somebody like me is settle. Okay, and why? Because even if you're right, and I got to be honest, most of the time the employer is not. There's been some kind of unintended mistake along the way. By the time you pay your lawyer to fight it, even to be right, or to shave what they're asking for down, you're going to drive up your lawyer fees. Under the Fair Labor Standards Act, the employee's attorney is paid by the employer. So if he gets $2, the employee gets $2, the lawyer may get $20,000. I'm sorry, what wages are owed are multiplied as liquidated damages. If you shortchanged a employee $10,000, you owe them 20. And you're going to walk in and we're going to tell you, pay it, because you're going to spend tens of thousands of dollars to fight it and maybe be right. And if you're right, the other side doesn't have to pay your attorney's fees. It's not a two-way street. Even if it was, good luck collecting from the typical employee. And so, what I hear is things like, well, what do you mean I'm getting sued? He was paid salary. I'm going to say, shut up and pay him. He wanted to be an independent contractor so he could get a 1099 and not have anything withhold. Shut up and pay him. He wanted to be paid off the books. Shut up and pay him. He was undocumented. Shut up and pay him. And for those of you who are Goodfellow fans, I cleaned that up a great deal from what I actually wanted to say.
I like that quote. I like that quote, Gary.
You know
And before, and before you
actually is, it's a little saltier.
Exactly. Oh, before you continue, Gary, I just want to let everybody know if they have any questions, start typing it up in the question comment bar, and Gary's going to answer them towards the end.
Okay, and now I'm going to try the technical aspect of this that I thought I had down, and I am so sorry. Let's try this again, guys. A window. You got to be kidding me.
It's not letting you share it.
I'm not. Am I in share mode? Got a document open.
I don't.
It
see
should be.
it.
So the rectangle on the bottom of the screen with the
Yeah, I
arrow
got that.
pointing up.
I got
Okay.
it. I
So
didn't
if you
get that part I knew.
okay,
Okay.
so if you click that, there you go.
That
Look at
part I
that.
knew. I'm not
He's
an
a
expert.
whiz. He's a whiz. He's an expert.
Exactly.
There
Let
we
him do
go.
his thing.
I'm a better attorney than I am a. What is that button? No. God damn. I'm sorry, guys.
No worries. Take your time.
I'm a better attorney than I am a IT guy.
Which is what we need from you. So that's good.
Okay.
Exactly.
Well, that's perfect. Okay. Most of you probably know, well, that some employees are exempt from overtime, some are not. Problem is, we tend to assume that folks are exempt when they're not. I'm sorry, I'm not getting this on my screen good, guys. Are we looking at error 1 misclassified exemptions?
Yes.
Excellent. Better than I thought. Okay. Here's the easy way to look at exemptions. Traditionally, we thought in terms of white collar, blue collar. Somebody who's a hot shot, who's a manager, who's an executive, who's a professional, who's making a lot of money, even though I'm wearing blue right now, doesn't get paid overtime for the most part. Somebody who's filing documents, turning a screwdriver, mopping a floor, does get overtime. And so what you have is there's 2 different columns. There's a salary test, meaning to be exempt, you have to be getting paid a salary. And then there's a duties test, which is essentially, it's to make it as simple as possible. You're a big shot. You get to exercise independent discretion regularly. You manage other people. You need both. It's not one or the other, it's both. Bill Gates, if he's getting paid hourly, is not an exempt employee. The guy that mops my floor, if he's getting paid salary, is not an exempt employee. You have to have both. So what is the white collar exemption? The number was going to go up under the Obama administration to the mid 50,000s. It did not, for a variety of reasons. It's $684 a week, which comes out to about $35,000 salary a year. That usually doesn't come into play because this day and age, most folks making less than $35,000 are not going to be probably hold that kind of position. The next is a duties test. The primary job is, again, what we talked about. It's exercising discretion, supervising other people. And I'm being overbroad here, but because I want to get to the gotcha moments. Heading a department, that sort of thing, having a lot of responsibility. And then the key here, and where the gotcha moments comes, because that's pretty easy. We can figure out pretty much looking at somebody 99 out of 100 times. What do? Do they run the store, or do they work on the cashier? That's usually not where the problem comes. The problem comes, let's see if we got this right. Oh, we're going to talk about the problem later. In fact, the problem, well, that's misclassifying them, right? Make sure you get it right. Make sure it's salary, make sure it's duty. The other thing that comes up there is this, and this is big, and you guys probably deal with this all the time, because independent contractor versus employee comes up in federal tax situations, state tax situations, whether someone's covered by workers' compensation, whether somebody's in the course and scope of their agency, and perhaps the company is responsible for their wrongful action. And here, fair labor, under whether someone's entitled to overtime or minimum wage. The the Fair Labor Standards Act has the broadest definition of who's an employee. That definition is changing weekly. It was one thing under the Trump administration. It was switched to something else under the Biden administration. One was more employer friendly, one was more employee friendly, obviously. And then last week, the judge struck the Biden administration change on a hyper technicality of executive branch rulemaking. And so it, in 1/11 of the country, it swung back last Wednesday to another test. In reality, this is, in general, this is what we think of. And again, you could be an independent contractor for purpose of the IRS and not for purposes of an overtime suit. Economic reality is what we're looking at. So we don't care if both sides sign an independent contractor agreement and both sides want to pay via 1099. Both sides, are happy to do that. Nobody cares when it comes to this. And really what it comes down to is economic reality is that person working for you? If that person wakes up and drives to work, or this day and age stays home and performs services for you, and you are the entity that person's relying on to put bread on your table, day after day, week after week, year after year, that walks like an employee, that talks like an employee, that quacks like an employee, that's an employee. And problems really rise in this because since we're not treating that person as an employee, no one's got time records, no one's keeping track of anything. But when a plaintiff's lawyer comes into court, judge is going to say, nope, that was an employee. Where's your records? Oh, you don't have them? Well, we're going to hold that against you. So I know all my clients love to call people independent contractors. A whole lot of economic advantage of that, including not paying workers' comp and not paying payroll tax and all that kind of stuff. Be careful. If you're going to do it, please make sure they're getting paid minimum wage and make sure they're working under 40 hours. Because that's a situation that can come up and bite you. And again, you're thinking you did nothing wrong. The other guy was happy with it. But the judge is not going to care. The next error that's made is deductions. We already talked about that you have to have the salary component for someone to be exempt. If you take out money from that person, if you're docking them in most circumstances, if they don't work a full week, so they only get 38th out of 40, whatever the salary would be, they're not a salaried employee anymore. You're treating them like an hourly employee. Salary employees don't get docked. They work, you're expecting them to work whatever hours a week it takes to do their job. And if they're getting docked, you're going to lose that salary exemption and they're going to become a non-exempt employee. And the only exceptions really, where you can take any money out from a salaried employee and not convert them to a non-exempt employee are the ones right now on the board. Full day deductions for personal reasons. Full day being the key. If they leave a half a day, if they have to go to the dentist, what have you, they don't get docked. Hourly employees get docked for things like that. True salaried employees do not. Again, full day absences for illness or injury. Where we have a planned policy or practice providing paid sick leave or other compensable time off. This is why it's important. If you don't have an employee handbook, we've got 100 reasons why you need one. You need sick time. You can give them 1 day a year. I don't care what it is. But when there's a sick time, PTO time in place, and the exempt salaried employee goes over that limit, you can, for full day deductions, not pay them and not lose that exempt status. Full day for disciplinary deductions. Why is that different than some of the ones above? Well, again, we've got sickness, we've got personal reasons. Disciplinary deductions means the employer sent them home. The first two is the employee couldn't get there. It's a difference. If it's, let's say, times are tough, and let's not even show up to work tomorrow. A salaried employee gets paid. Okay. Down here we have hurricane days. I'm sure everywhere else we have natural disaster days. Salary employees get paid. If they don't, that you're treating them like an hourly employee, and you're going to lose the exemption. Family medical leave days, we don't have to pay. If there's a week that goes by that an employee does not work for whatever reason, they don't get paid. If they show up for a half a day and they're gone for one of these other reasons, they get paid. And if they don't, we risk losing the exemption. Now we've got a problem that ties more to minimum wage. Like I talked about earlier, we took $2 out of, a client took $2 out a week, actually every 2 weeks, and destroyed the minimum wage. This is what you cannot do if you've got employees making lower than minimum wage. And that was a tipped employee. That's a whole nother mess I'm not even going to get into. But this is what we run into all the time. You want to take money out of somebody's, out of somebody's paycheck that's making close to minimum wage, right? They could be making a lot more, but there's a lot of money missing. You can't do it. Uniforms and tools used in the employee's job, like the problem I had this morning, they would make on the first day of work, you'd have to buy a polo with the logo of your, Joe's Bar and Grill. You're doing that with folks that are making close to minimum wage, you're going to get sued for it. And again, you could get sued for 1 week. And by the time you're done paying off the lawyer, and you're done paying your lawyer, and you're done paying whatever you owe, you're thousands of dollars out. No ifs, ands, and buts. And unlike some other statutes where perhaps they're going to go to the EEOC, you get no heads up. Typically, in an FLSA lawsuit, the first notice you get is process servers come out and handed you a lawsuit. And then you're in the game. There's nothing you can do. Loss or theft of employer's property. I've had a busy couple of weeks. I've had 2 clients that we just discovered 2 separate issues, over $100,000 in embezzlement by their trusted bookkeepers. And we fired them. Actually, we fired them, and I told the police to take them away. And someone left in cuffs last week, which was a first for me. My client said, "What do I do with her last day's paycheck?" And I'm like, "You pay her minimum wage. That last paycheck we owe her, we're not going below minimum wage. I don't care that she stole $160,000. We're not buying a lawsuit." Same thing. They drove the forklift into the wall. Now, if you've got hopefully you've got a policy and they've signed off on it, that they understand they're responsible for their own negligence and damage to the property. But still, we're going to leave them minimum wage. We'll figure out the $5,000 damage to the property. We're going to take it out a little at a time. They get minimum wage. Again, you see the customers not paying their bills. Oftentimes, a member of a wait staff, they run out on the bill, and the employer wants to take it away from the paycheck. You can do it. as long as you're not going under the minimum wage. And these are the things that folks think they're doing the right thing. And the best intentioned employers out there think they're doing right, and they're gonna buy themselves a lawsuit that's going to cost thousands of dollars, no matter what. Because in fact they're wrong. Working off the clock, and I'm looking at the time, so I may speed this up a little bit. Working off the clock. A schedule does not matter. What matters is when they're working, and the more we go to remote work, the more, especially with COVID, the scarier this becomes, and the more important it is to really track time and put the onus on the employee to engage in tracking their own time. One of the okay, we're going to pay them for the regular work activities. Traveling, if it's part of their duties. Typically, you're not paying for someone to drive to work or after work to home, but if they're stopping along the way to pick up another employee for you, they're doing something that benefits the employer. If they're pulling into Home Depot to pick up some supplies and then they're coming to work, as soon as they deviate from their route to the employer, they're on the clock. So again, make sure you're tracking these things. Meal breaks, 30 minutes or more. Anything under 30 minutes, they've stayed on the clock. And we get this all the time. And if you're not tracking time, you're going to be dead on this, because I cannot tell you how many times I've heard, oh, the employee, oh, she always worked through lunch. She was there working through lunch, and the boss knew it. And even if you have a written policy that says you must take a 30-minute lunch, do not work through lunch. If the employee's sitting at her desk or his desk and performing any functions, even if it's, I need to hang out here in case somebody calls, they're on the clock. They work 1 minute answering one email during that 30 minutes or during that hour lunch break. There was no break. They're on the clock. And all of a sudden that 38 or 39 or 40-hour week just blew into overtime. The employee needs to be free to leave the post. I would prefer, any way possible, to not let your employee eat at their workstation. That became much more prevalent, obviously, with COVID, when folks were at the office and we said, don't all gather into the lunchroom or the break room. But we need to do our best. And the best way, obviously, is a timekeeping system, perhaps computerized, where somebody punches out and punches in. And then with the help of written policy directing them not to perform any work during the meal break, you've got a defense. Okay, here we go. The worst thing I ever see is like a handwritten on a timesheet, 9 to 5, 9 to 5, 9 to 5, 9 to 5. That's useless in defending a Fair Labor Standards Act case, because everybody knows nobody starts work at 9 to 5. You start at 8:58. You get off at 5:04. 9 to 5, you might as well not have a document. A judge is just going to roll their eyes, and for good reason. Same thing with 9 to 12, 12:30 to 5:30. If you're going to do handwritten time records, make them accurate. Again, this day and age, it's all kind of electronic and computerized ways of keeping time. I highly recommend that's what you do. With remote work, again, this has gotten scarier and scarier, because how do you know? At least if someone the old days is sitting in the office, you can walk by and say, "What are you doing?" Or "It's 5:30. What are you still doing here?" It's harder to do that when someone's sitting at their house, which again, sound like a broken record. a computerized time system is vital. If an employee is waiting to do their job, they need to be paid to wait. It's the difference of being, waiting to work and working to wait. If someone has a job that's weather affected and we're going to take a break, and when the sun comes out in a couple hours, we're going to start, they're on the clock. If there's something that's going on and we can't start because we can't get the factory door open, they're on the clock. If the time's not there, if they're on call, okay, and this has gotten a little easier in the age of cell phones. It used to be much clearer. You were sitting at your house and you're waiting for the call. If you're on call and the employee cannot do anything they want on call, they're on the clock. Even if it's don't leave, I need you here within 15 miles in case something happens, they're most likely on the clock. So be careful of that. Be careful of employees answering emails after hours, fielding phone calls after hours. They're on the clock, and they're going to come back and say, there's going to be a lawyer coming back and say that those emails, and it's always going to be longer than it was, right? It's always going to be every Saturday I put in 2 to 3 hours of work. But the employer told me not to clock in and out. Those emails, those phone calls, which are easy to document, is going to cost a lawsuit, and you're going to walk, and your employer is going to say, you're wrong, we're dead, you need to settle. When we are trying to be good and we're trying to pay overtime the appropriate way, we need to take into account everything that employees getting paid. Because remember, time and a half, it's easy if someone's making $10 an hour to realize when they go over 40, it's $15 an hour, right? But when that person's getting paid over and above their annuals, their typical hourly wage, and we forget that, they're not getting paid time and a half. And what are the kind of things we're talking about? If we're not taking commissions into account, if they're making commissions every month, then their actual hourly rate is not $10 an hour. It's $10 an hour plus the commissions divided by the hours they've worked. Same thing with bonuses. If you hit X amount of sales, you're gonna be paid $25,000. Well, that's their pay. And when we're factoring in time and a half, we have to factor in everything they're being paid. Even things like room and board goes in. They're getting paid more than $10 or $20 an hour. They're getting that plus room and board. We've just changed the hourly rate a great deal. And again, we talked about, I have that twice, non-discretionary bonuses. And I have it twice because it's so nice. We're going to have a separate one just dealing with bonuses. Non-discretionary bonuses. This we don't have to worry about, okay? Christmas bonus, we're doing it because we're happy. We're doing it because the business is thriving. We're doing that because we know the employee has had a really tough time of it. We want to help out. That is not going to affect the employee's regular rate of pay. Doesn't impact what you have to pay them time and a half. However, if they're legally entitled to a bonus, if you've promised them at the end of the year they're going to get X, or if the company makes X number of dollars, you're going to share in Y. Anything where the employer is compelled by law, and by law I mean by agreement with the employee, to pay them, that's part of their compensation package, and their regular hourly rate is supposed to be factored in on their full compensation package. Travel time. Again, we talked about this before, and it becomes a real mess when we're dealing with folks going out of the area. Overnight trips are a nightmare for this. And frankly, it's a case-by-case basis. Sometimes it matters if the employee is traveling on a typical work day or not. If you work Monday through Friday typically, but Sunday you need to fly up to Philadelphia to get ready for a Monday morning meeting, you're probably not on the clock Sunday. But if you're flying up Monday for a meeting on Tuesday, you probably are on the clock. You are on the clock. Again, coming to and from work typically, not travel time. You've deviated from your route to help the benefit the employer. You're on the clock. You check in at the home office or the home shed or whatever it is, and then go off to the work site, you're on the clock. If you drive directly to the work site, you're not on the clock. So it really is dependent on the specific fact pattern. It's tough to generalize, but these are situations where folks step into those potholes and those gotcha moments occur. And we'll get to sloppy record keeping. And we already talked about sometimes we're not keeping records because we assume it's not going to be an issue. It's an independent contractor. It's a salaried employee. And when those situations occur and all of a sudden they're screaming, I am entitled to overtime. You should have treated me like an hourly employee. I am entitled to minimum wage. And we don't have records. It's a dangerous situation to be in. And because of it, the Department of Labor puts the onus on the employers to keep records, to keep their time records, to keep their pay records. And if the employer doesn't have those records or didn't keep those records, there's a legal presumption that whatever story the employee is coming up with is the truth. I used to leave at 6 o'clock all the time. Well, there's a presumption they left at 6 o'clock all the time. Is it a rebuttable presumption? Sure. If we've got surveillance films, we've got a camera out there that says, no, you always left at 5 o'clock. Oh, well, we certainly bring that up. If you've got 5 employees that say she was the first one in the elevator as soon as the clock struck 5, you can use that. But if you don't have that kind of evidence and you haven't kept records, you're going to be in trouble. And again, the reason is that the law says you're supposed to keep the records, and you're going to get punished for it. And I think lastly, ignoring state law. We talked about before at the beginning of this, most states have their own minimum wage and their own overtime statutes. And it typically comes up in minimum wage, where it's different than $7.25. Here in Florida, it's $10 and it's going up now twice a year. The employee, it should be obvious, but the employee is entitled to the higher of those amounts. In Florida, for instance, there's a 4 or 5 year statute of limitations. So you can look back in time and the employee can make claims for being underpaid for 4 years, and if it's willful, for 5 years. Under federal law, it's 2 years, and if it's willful, 3 years. Again, each state has their own, most states have their own law on this. It's vitally important you know what your state law is. You probably do, but what folks don't track is, especially in the day of remote work, my company's in Florida, my employee's sitting at her desk in San Francisco. Well, we better be looking at what California law is and what San Francisco municipal ordinance is. because that's a San Francisco employee, and we better be up on what we owe that person and what rules we owe that person. And that's much broader than just the Fair Labor Standards Act. That goes from how quick do you have to give somebody a final paycheck? Was that person terminable at will? Don't just assume where you're sitting is the law that's going to be applied. You need to factor in where they're sitting. For instance, a client terminated the other day a Boston employee, Florida corporation, employee sitting at her desk in her apartment in Boston. Well, Boston has laws that say you can be sued. I may get this right, and anyone up there in Massachusetts, don't hold me to this. But it's essentially, if you fire somebody within 40, or they quit within 48 hours, there needs to be a paycheck in their hand. Most states are, you pay them on your reasonable payroll time frame. If that paycheck is not in hand in 48 hours, a lawyer can rush into court, sue, and again, be entitled to attorney's fees. So for a variety of reasons, please don't forget that where your employees are sitting is vitally important. Providing comp time. This is one of my favorites. We talked about, we look at each work week in a vacuum. And let's just go with Monday 12:01 a.m. till Sunday midnight. We look at that 7-day period as how many hours were worked. A lot of us pay on, let's say, every 2 weeks. Somebody works 38 hours one week, 42 hours the next. They're entitled to overtime. Doesn't matter that it's 80, that it looks all right for a 2-week period. For one of those 1 week vacuums of time, they work two hours of overtime. And I cannot tell you how many times I've seen that, and everybody looks at, the paycheck 80 hours, paycheck 78 hours, and it's a 2-week paycheck and thinking they're okay. They are not. When you're being paid on it would be bi-monthly, semi-monthly pay schedule, where it's not 2 weeks. Now we've got 15 days or 14 days or 16 days. From my perspective, it's a nightmare because, again, doesn't matter when we're paying them. It matters when the work week's running and do they work 40 hours in that week? If they work a Sunday, is it on this week? Is it that week? And too often it's, oh, you worked 6 hours last week. Why don't you take Friday off this week and we'll make up for that. Does not work that way. That's 6 days. 6 days 1 week, we can't make it 4 the next. We have to pay for that 6th day. I've had clients, again, they bank it. We work overtime, but we give them a bank and then they can use it whenever they want. No. It would be closer if you were giving them an hour and a half for each banked hour, but even that does not comply with the law because the law says the employee should be paid promptly, consistent with your regular pay schedule. So banking hours, giving somebody a week off the next week, even if it's in the same paycheck, is just another way of stepping in a pothole. And this does not come into play that often, thankfully, but if you've got employees that are doing multiple jobs, and a lot of small businesses will have that. I've got a case pending right now where it was the employee, it was an assisted living facility. The employee would take care of the residents, but she also wanted to make money. So she would say to her boss, hey, don't pay for an outside painter to freshen up that room. I'll come in on Saturday and you can pay me. That gets very tricky. You know, in that situation, I'm arguing that those were two different jobs and those hours don't add. And in fact, we were paying that person as a 1099 independent contractor for the separate painting. I'm not in love with the argument, but it's what I have to do. If an employee's wearing two different hats like that and they're being paid hourly, remember, if they go over 40 hours, we need to figure out what they're really being paid. If that week they worked 25 hours at one hourly rate and 20 hours at another, we've got to do some math before we figure out what time and a half is going to be. And I think